Hey everyone, it feels good to connect with you tonight. Just having a chat about something that truly matters, our financial future. I remember when I was first starting out, I was just 20 years old, maybe a little naive. I thought investing meant being a stock market wizard, constantly tracking news, making these huge risky bets, trying to find that one stock that would just explode overnight. I spent so much time chasing those flashy stories. The next big thing, the cryptocurrency that promised to go 100x, or even trying my hand at day trading, hoping to catch those quick gains, it felt like a high stakes game, and honestly, it was exhausting. I celebrate small wins, but then watch them disappear just as fast. It was a roller coaster of emotions. I truly believe that to get rich, you had to be incredibly smart, always ahead of the curve, constantly outsmarting the market. But then something shifted in my perspective. I started reading, really diving deep into the data, listening to the wisdom of people who had actually built lasting wealth, not just temporary fortunes. And what I discovered was almost counterintuitive. The secret to building substantial wealth, especially in your 20s, wasn't about complexity. It was about radical simplicity. What if I told you there is one investment, just one, that if you buy it consistently, patiently, month after month, year after year, it will make you extremely rich? No. It is not a secret stock tip. It is not some exotic asset. It is something incredibly mundane, almost boring, but profoundly powerful. Most people, especially in their 20s, overcomplicate investing. They feel this pressure to diversify into 30, 40, 50 different stocks or to be a financial genius. But the truth is, you don't need any of that. You just need one thing to invest in. And that, my friends, is the SP 500, specifically through an ETF like VU. That is my personal choice. And in this conversation tonight, I want to explain why I genuinely believe this is the only investment you truly need for long-term success, for building real, undeniable wealth. Before we dive deeper, I am curious, what do you think is smarter, owning an ETF that holds 500 companies, giving you instant diversification, or trying to pick individual stocks, hoping you choose the winners? Go ahead and share your thoughts in the comments below. I'd genuinely love to hear your perspective. There is no right or wrong answer here, just different approaches. So, let us start with the basics. What exactly is VOO, or the SP 500? VOO is simply Vanguard's exchange-traded fund that tracks the SP 500 index. The SP 500 itself is a collection of the 500 largest publicly traded companies in the United States. Think of names like Microsoft, Apple, Amazon, JP Morgan. These are the giants that drive the American economy. The beauty of buying VOO is that it offers instant diversification. The moment you buy just one share, you are essentially owning tiny pieces of 500 different companies. This significantly reduces your risk compared to putting all your eggs in one or two individual stock baskets. Another incredibly appealing aspect is its expense ratio. It is incredibly low, only 0.03%. This means the cost of owning this ETF, the fee you pay for this incredible diversification, is almost negligible. You are not paying a financial advisor 1% or even 0.5% a year to try and beat the market, because with VOO, you are effectively owning the market. And here is a humbling truth. Most financial advisors and even actively managed mutual funds struggle to consistently beat the SP 500 over the long term. It is an incredibly difficult feat, so why not just join the market? Why not capture its returns directly? Even Warren Buffett, widely considered the greatest investor of all time, has often advised most people to simply buy the SP 500, believing it is a solid path to financial well-being. While he has built his immense wealth on picking individual stocks and identifying huge winners, his advice for the average person is clear and straightforward: invest in the SP 500. And taking advice from someone with that kind of track record, well, it doesn't sound like a dumb idea to me. Now, let us talk about returns. The average annual return of the SP 500 can vary year by year, but historically it averages around 10% per year, which is really quite impressive. Some years it might soar, returning 20% or even more. For example, if you look at 2023 and 2024, the market experienced a significant rebound from 2022, showing gains of 20% plus in back-to-back years. But, and this is important, there will also be years when it goes down. We've seen significant crashes throughout history. Think back to the dot-com bubble burst between 2000 and 2002. That was a pretty substantial crash. Then there was the 2008 housing crisis, a severe downturn that impacted millions, and more recently the COVID crash in 2020, a sharp but relatively quick drop, and then the market correction in 2022, largely driven by inflation concerns and rising interest rates. But here is the crucial point: if you consistently invest into the SP 500 over time, these downturns become opportunities. Let us run a hypothetical scenario. Imagine you are 20 years old today, starting with $0, and you plan to invest for 40 years until you are 60 if you commit to investing $500 every single month. And we conservatively estimate an average annual return of 8%. Factoring in inflation from the historical 10% average, after 40 years you would accumulate approximately $1.5 million. Now here is the truly mind-blowing part. Your total personal contributions over those 40 years would only amount to $240,000. That is the incredible power of compound interest. Working its magic over time, time truly is your greatest asset here. Let us extend that scenario slightly. What if you invested for 45 years, waiting until you are 65? That $1.5 million would climb to an astonishing $2.3 million. Those extra 5 years alone added $800,000 to your investment account just by letting time and compounding do their work. And that is just with $500 a month. What if you were able to ramp up your contributions over time, say to $1,000 a month in that same 40-year scenario? Your total would reach $3.1 million, even though your total contributions would only be $480,000. And if we go to the 45-year scenario, that number jumps even higher to $4.6 million. That is the undeniable power of consistently earning even 8% a year. It is not about huge, unrealistic returns. It is about the steady mathematical certainty of compounding. Investing $500 or even $1,000 a month over 30, 40, or more years is going to make you very, very rich. It is a slow burn, but an incredibly effective one. I think one of the biggest hurdles for people in their 20s is this desire to get rich quickly. There is often this unspoken pressure, a feeling that by 25 you need a house, a certain amount invested, a specific income. But with the SP 500, you are embracing the path of getting rich slowly. It won't happen overnight, but the more consistent you are, the more money you invest, the larger your portfolio will grow. It won't give you a 100x return in a year. It won't have some crazy sensational gain, but it will grow a very substantial amount, especially if you commit to it consistently over decades. Think about it this way. Let's say you reach a point where you have $100,000 invested in the market. If you have a particularly good year and the market returns 20%, which I know is above the average 10%, but it happens. You just earned $20,000 extra in your account without doing anything, without lifting a finger. Imagine starting January 1st with $100,000, not adding any more money that year. And by December, you are at $120,000. That is passive income generated by your existing capital. Now, to make that example even more exciting, let us add another zero. Imagine you one day reach $1 million invested. A 20% return on that is $200,000 just in 1 year. That is life-changing money generated purely by the market's performance, while $1 million or even $100,000 might seem incredibly far away right now. The more you invest earlier on, the easier and faster it becomes to grow. Going from $0 to $10,000 might take you 6 months, but then going from $10,000 to $20,000 will likely take less time, assuming the market performs at its normal rate. And then 20 to 30 will be quicker, 30 to 40 even quicker. It accelerates over time. So keep this in mind. You may only need to invest 50, 60, or $70,000 of your own money to see your portfolio reach $100,000 thanks to market appreciation. And with the SP 500 consistently returning around 10% a year, it definitely beats inflation over the long run. Inflation, as we know, averages around 2% a year, so your investment is actually growing in real terms in purchasing power. This is a far better alternative than just holding cash, because if you keep your money in a checking or savings account earning almost no interest, its value is actually decreasing every year due to inflation. That $1 you have today will buy you less next year, simply because the price of everything tends to go up over time. Now, let us talk about why I believe the SP 500 is absolutely perfect for you in your 20s. The main reason, as I've touched upon, is time. You have an incredible advantage. Compound interest does almost all the heavy lifting for you, whether you start at 20, 25, or even 29 or 30. If you begin in your 20s, you have so much time for your investments to grow. And time is your best friend when it comes to compounding. Don't get me wrong, the interest rate matters too, but ultimately the longer your time horizon, the better. We saw that clearly when comparing the 40-year versus 45-year scenarios. The difference was massive. The next reason it is perfect for young investors is its extremely low effort nature. You really don't need to check it every day. It is not a complicated investment. If the market has a good year, great, just keep buying consistently. And if it has a bad year, that is perfectly okay too. My mindset, the logic I try to embrace is this. If I invest $1,000 and it goes up, awesome. My $1,000 is now worth more, I've made money. But if I invest $1,000 and the SP 500 drops, that actually gives me an incredible opportunity to buy an asset that has historically gone up over time. But now it is on a discount. It is like when you want a new pair of shoes or any item you've been eyeing. If it suddenly goes on sale 20 or 30% off, you are much more likely to buy it, right? You need to view market downturns in the same way. It is a win-win scenario. Either your investment goes up and you make money, which is fantastic, or your investment goes down temporarily, which is also fine because you get to buy the dip, you get to acquire a high-quality asset at a lower price. Adopting that logic will serve you incredibly well long-term, especially during those inevitable crashes where the market might drop for 6 months, 8 months, or even over a year. Those are simply really good buying opportunities. Another thing I love about VU is its low cost. As I mentioned, the expense ratio is incredibly low. You are not paying a manager 1% a year to manage your money only for them to underperform the market. And believe me, that 1% difference between, say, 8% and 7% annual returns over a 30 or 40-year period can easily amount to hundreds of thousands of dollars. So the low-cost aspect is a significant advantage, preserving your returns over the long haul. The next point I want to emphasize is that it involves far less stress. And the reason I believe this is critical is because when you invest in individual stocks, you are placing a lot of bets. If you put all your money into just 5 stocks, you are essentially banking on those 5 companies doing exceptionally well. They need to consistently deliver strong earnings. Their business operations must not decline. Revenue, profit, free cash flow all need to keep growing. You find yourself constantly scrutinizing earnings calls, analyzing business operations, and hoping all your individual investments continue to perform over a long period. But history shows us that even great companies can falter. Many companies that were dominant in the 90s completely tanked in the 2000s. Some vanished entirely. A company can perform brilliantly for 10, 15, even 20 years, and then experience a horrible 5 to 10-year period. Think of examples like 3M or Walgreens. I remember growing up seeing Walgreens everywhere, but over the past decade, it has been a truly terrible stock to own. If you told someone that in 2004 or 2005, they probably would have laughed. AT&T is another perfect example, a powerhouse in the late 90s, but since then, it has performed horribly. Not a good company to hold for long-term growth. When you own the S&P 500, you don't have to stress about individual companies. It is the 500 largest companies. If a company like Apple, currently one of the largest in the world, were to shrink and drop out of the top 500, say to rank 510 or 515, it would simply be removed from the S&P 500. The S&P 500 has this built-in self-correction mechanism, constantly filtering companies in and out based on their size and performance. And as companies grow or shrink, their allocation within the S&P 500 adjusts. For instance, Nvidia has performed exceptionally well over the past 5 years, becoming a larger percentage of the S&P 500. This is a beautiful dynamic. As companies succeed and grow bigger, they naturally command a larger portion of the total index, capturing their success for you. At the end of the day, investing in your 20s is about consistency. You don't need to be the smartest person in the room. You just need to be the most consistent, work hard at your savings rate, and you will see remarkable results. So, how do you actually go about investing in the S&P 500? It is quite straightforward. You can open a brokerage account. This is a general investment account where you can deposit money, buy and sell stocks or ETFs, and manage your cash. Just be aware, if you decide to sell investments and realize a profit in a brokerage account, you will have to pay taxes on those gains. So keep that in mind. But essentially, you open a brokerage account. I personally use M1 Finance, but you could also use Vanguard, Fidelity, Schwab. There are many reputable options. Once your account is set up, you search for the ticker symbol VOO and start buying shares. A great feature many platforms offer is automated investing. You can set it up to automatically pull a certain amount of money from your bank account every week or month. So you could set it to invest $500 a month into VOO without even thinking about it. The money is automatically transferred and the shares are purchased for you.